Cost of capital. In this reading, we will first discuss the cost of capital, what this means, and how to calculate the cost of capital. We then talk about the costs of different sources of capital, recognizing that there are three main sources of capital. One is debt, preferred shares, and common shares or equity. So we need to understand how to compute the cost of debt, cost of preferred shares, and cost of equity. We will then cover a few miscellaneous topics related to cost of capital estimation. Let us understand the basic concept behind cost of capital. Cost of capital is the rate of return that suppliers of capital require as compensation for their contribution of capital. Simplistically put, a given company needs money. The money that it raises is called financial capital. There are two primary sources of capital: debt, which is money coming from lenders, or equity, which is money that is contributed by owners. When a lender lends money to a company, obviously he is expecting a return. The return that the lender expects is a cost from a company perspective. So you need to understand this. When the investor, here we will talk about a lender, lends money to the company, the investor is expecting a return for lending that money. That is an investment return from the investor perspective, but from the company perspective, the company is receiving money and it needs to pay a return to the investor. From the company perspective, that is a cost. The other primary source of capital for a company is the money that is contributed by owners. Again, when owners contribute money to a company, they are also expecting a return. Simply put, this return would be in the form of dividends. And again, owners would expect a certain return, and that is called the return on equity. For the company, that would be a cost. Second point, a company will invest in a given project if the return is greater than the cost of capital. This is related to an item we discussed in the previous reading, where we talked about the IRR rule, and we said that we invest in a project if the IRR is greater than the cost of capital or the required return. Notice that we use the terms cost of capital and required return interchangeably. If for a given company the overall cost of raising money from lenders and owners is 10%, this will be our cost of capital, or this will be the required return. We will invest that money in a project if the return on the project, or simplistically the IRR of the project, is greater than 10%. So if the return is 15% on a project, then it would make sense to raise money at a cost of 10% so as to engage in a project that will give us 15%. The third major point on the slide is that riskier projects will have a higher cost of capital. This is something we'll discuss later, but it is a core concept in finance that low risk projects will have a relatively low cost of capital and higher risk projects will have a higher cost of capital. And finally, in terms of terminology, you will hear the term marginal cost of capital. Marginal means additional. So marginal cost of capital means what's the cost of raising additional capital. When we talk about investment return greater than cost of capital, we are really talking about the investment return being greater than the marginal cost of capital. Another related term which is quite commonly used is weighted average cost of capital, or WACC. And that is what we will talk about on this slide. How do we calculate the cost of capital? What we do is take the weighted average of the cost of capital from different sources. We have three primary sources of capital: debt, preferred shares, and equity or common shares. In the previous slide, we simplistically just considered debt and equity. Now we also take the intermediate category, which is preferred shares. The cost of capital is really a weighted average of the cost of capital from these three sources, and that is expressed through this equation. Weighted average cost of capital is equal to the weight of debt. So if a given company has raised a total of 100 million, of which 20 million comes from debt, then the weight of debt is 20 over 100, which is 0.2. Let's say that the company is paying an interest rate of 10% on this debt, then the cost of debt would be 10% or 0.1. The interest paid on debt is tax deductible, so we multiply by 1 minus t, and I'll discuss this in more detail later. So we then multiply this by 1 minus the tax rate. Say the tax rate is 40%, so we multiply by 1 minus 0.4. We do this because interest payments are tax deductible, and we'll discuss this in more detail later. Next, we come to preferred shares. Let's say that of this total capital of 100, preferred shares represents 30%. We therefore have a weightage of 0.3, and let's say the cost of preferred shares is 12%. We multiply by 12% or 0.12, and finally we have the weight of equity or common shares, which then becomes 0.5 multiplied by the cost of equity. If that is 15%, this is then multiplied by 0.15. What we have done here is taken the weighted average of the cost of these different sources of capital. That's why we call this term the weighted average cost of capital. You will also see this term marginal, and as indicated before, marginal means additional. When we are talking about the cost of debt or cost of equity, we are really concerned with the cost of raising additional debt or raising additional equity. Don't get too confused by this term marginal, though it doesn't really change the calculations that you need to do. Let's do a simple example. IFT has the following capital structure: 30% debt, 10% preferred stock, 60% equity. You are given the before tax cost of debt, which is 8%. You are given the cost of preferred stock and the cost of equity. The marginal tax rate is 40%. What is the weighted average cost of capital? Here is what you should come up with: 11.44%, and we are simply using the formula that we saw on the previous slide. This is an extremely important formula, so you need to know it well. The weight of debt into the cost of debt times 1 minus the tax rate plus the weight of preferred shares into the cost of preferred shares plus the weight of common shares or equity times the cost of equity. Here is another important example. Pause the video and do this before you look at the answer. The correct answer is B. You are given lots of numbers, but the main point is that when you make a capital budgeting decision, you need to compare the investment return with the cost of capital or the weighted average cost of capital. If the IRR is greater than the WACC, then you go for the project. If the return is less than the WACC, then you do not go for the project. Here the weighted average cost of capital is given as 7%, so that is what you consider. Coming now to taxes and cost of capital. You will notice from the formula that we just discussed that we only consider taxes when we deal with debt. We do not consider taxes when we are talking about the cost of preferred shares or the cost of equity. The reason is that the money paid to preferred shareholders or the money paid to common shareholders is not tax deductible. the dividends do not reduce the tax payments of a company. That's this first point. Interest payments, however, are tax deductible and they reduce the tax that a company needs to pay, which means that they provide a tax savings. So the 1 minus T that we saw in the expression on the previous slide has to do with the fact that we have this tax saving. In general, whenever you have a cost of debt, you are going to multiply it by 1 minus T to represent that tax saving. What I'm going to do on this slide is explain to you why we multiply by 1 minus T. You just need to understand this once in your life, and then after that you simply use this expression. Let's say we have a company which has debt equal to 100. The interest rate is 10% and the tax rate is 40%. An interest rate of 10% means that the company is actually paying an interest amount of 10 to the lender. Let us do two calculations. On the left, we assume that the interest payment is tax deductible. This is the normal scenario. This is what happens in most countries. And just to illustrate a point, we will also do a calculation assuming that interest is not tax deductible. If you look at the left side of the screen, we have a simple income statement. Revenue is 100, operating expenses 50, interest is 10. Interest is tax deductible, so it reduces the EBT amount. The EBT is 40. The tax is paid against 40. If the tax is 40%, then the tax expense is 16 and the net income is 24. On the right, we assume that interest payments are not tax deductible. So you calculate a EBT of 50. The tax expense here is 20. Notice that 20 is 4 more than the tax expense on the left. And then obviously the net income is 4 less than what we have on the left. The point here is that because interest is tax deductible, it is reducing our taxes. So effectively, the cost of debt isn't 10, it is actually only 6. We do pay 10, but we save 4 in taxes. So effectively, the cost of debt is 6, or with this simple example, that represents 6%. And you will now see how this formula works. The RD represents the before tax cost of debt, which is 10%, and then we multiply by 1 minus T. Tax rate is 40% or 0.4, so you multiply by 1 minus 0.4 and you are left with 6%, which is what we see here anyway. After tax cost of debt is before tax cost of debt into 1 minus the tax rate. Do example 2 from the curriculum. That is a simple illustration of this concept. Coming now to the weights of the weighted average. We have talked about the weight of debt times the cost of debt, and then the weight of equity into cost of equity. Let's take a simple scenario where we don't have any preferred shares. How do you come up with these weights? From a testability perspective, there are 2 key points to remember. If you are given both book value and market value for debt and equity. So if we have book value of debt is 20 and market value of debt is also 20, but with equity, let's say that the book value is 40, but the market value is 80. So what are the weightages that you use? Answer is that you have to use market values, because market values represent the economic reality. So simple point, use market values when you come up with the weightages. The other point is that when you use weightages, you need to consider the target capital structure. Capital structure refers to the relative proportion of debt and equity. If a company has a current capital structure where debt is 10% and equity is equal to 90%, but the target capital structure based on announcements made by the company is as follows: debt 20% and equity 80%, then in your weightage you need to use the target capital structure. The reason is this: we are using the weighted average cost of capital for decision making. If the company has announced that its target capital structure is 20/80, then when it raises new capital, it will raise capital in this proportion. And obviously, when we are comparing the return on a project that we'll do in the future, it needs to be compared with the cost of capital based on the proportion that the company will actually be using. In any case, point to remember: when given a choice between current capital structure and target capital structure, you need to use target capital structure in coming up with the weights. Practically speaking, there will be situations where you as an analyst do not know the target capital structure. So what do? The simplest thing is to use the current capital structure, assuming that the current capital structure represents the target capital structure. Another strategy is to look at the trend. If you are noticing that the company is increasing its level of debt, you can use your judgment and the trend that you are observing to come up with the target capital structure. That is subjective, but not a very critical point from an exam perspective. Or you can use the average of comparable companies. And this is illustrated well in example 3. It is a somewhat long-winded example, but the concept is very straightforward. This should be a really simple example given that we've just talked about the subject matter. You gather the following information about the capital structure and before tax component costs for a company. You are given the tax rate, what is the cost of capital. The key point here is that you are supposed to use market values. So to do a cost of capital calculation, which hopefully you are getting comfortable with, we need to come up with our weightages and then multiply by the component cost. Here is what you should get. Marginal cost of capital and investment opportunity schedule, or IOS. What we are looking at here is the marginal cost of capital, which is the red line, and the investment opportunity schedule, which is the blue line. The marginal cost of capital we have already talked about. As we raise additional amounts of new capital, the cost of capital goes up. The way you can think of this is as follows. If you go to a bank and borrow money, there will be a certain rate. As you try to borrow more and more money, the riskiness goes up, so the cost of borrowing will go up. The same goes with equity. As you try and raise more and more money, the riskiness potentially goes up and the cost goes up. So simplistically put, as we try to raise more money or more capital, the cost of capital goes up. The blue line represents the investment opportunity schedule. Clearly, when you do projects, you will first do the high profitability or the high IRR projects. Therefore, with the initial amount of money that you have, notice that the return is going to be high. You then do projects that still have a decent IRR, but where the return is relatively less. And therefore, the investment opportunity schedule is downward sloping. The optimal capital budget is given by the intersection of these two lines. If you are at this point over here, then the return that you are getting on your projects is greater than the cost of capital, and that means that you are adding value. The NPV of doing these projects is positive. So it makes sense to keep going. As long as you are to the left of the optimal capital budget, it makes sense to raise new money and do projects because the return is more than the cost, so the NPV is positive. To the right of the optimal capital budget, the return represented by the blue line is less than the cost, which means that NPV is negative, so it doesn't make sense to be on the right of the optimal capital budget. And therefore, this point represents the optimal capital budget. Role of WACC, or weighted average cost of capital. The important points are written over here, so I will simply read them. For average risk projects, we should use the weighted average cost of capital to compute NPV, and this is what we did in the previous reading on capital budgeting. Adjustments to the cost of capital are necessary when a project differs in risk from the average risk of a firm's existing projects. The discount rate, or the WACC, should be adjusted upwards for higher risk projects and downwards for lower risk projects. This is fairly self-evident. Coming now to the costs of the different sources of capital. Each source of capital has a different cost because of differences in seniority, contractual commitments, and potential value as a tax shield. Seniority and contractual commitments essentially indicate the risk. When we talk about seniority, what we mean is the following. If a company raises money through debt and equity, debt is senior to equity because if a company is liquidating, then the payments need to be made first to the debt holders. Even if a company is not liquidating, the interest payments have to be made first before any dividend payments are made to equity holders. The interest payments are also required through contracts. We therefore say that debt is less risky than equity. If debt is less risky than equity, then the cost of debt is also going to be lower because investors will be happy with a low return on debt relative to equity. The other way of looking at it is that with equity, investors are taking a higher risk. Therefore, they are expecting a higher return. Higher return for investors means higher cost for the company. The tax shield also needs to be considered when we talk about the cost of a given source of capital. As we've said several times, the three primary sources of capital are debt, preferred shares or preferred equity, and common equity. And now we are going to determine the cost, or we are going to learn how to come up with the cost of each of these sources. Let's start with cost of debt. Cost of debt is the cost of debt financing to a company when it issues a bond or takes out a bank loan. There are two methods. One is to use the yield to maturity approach. The other is debt rating approach. These apply primarily when we are dealing with bonds. If a company simply takes out a bank loan, then the interest rate represents the cost of debt. Yield to maturity approach, this is fairly testable. This is material that you saw in financial reporting and analysis in the reading on non-current liabilities, and you will see this again when we do fixed income. So it comes in three places in the curriculum, and that means that this is important. The yield to maturity is the annual return that an investor earns if he purchases the bond today and holds it until maturity. A company issues a 10-year 8% semi-annual coupon bond. Upon issue, the bond sells for $980. If the marginal tax rate is 30%, what is the after-tax cost of debt? We are looking at this from a company perspective. The way you solve this problem is first calculate the before-tax cost of debt, and we do this using our calculator. Notice that we are not given the par value, but when you have a issue price of 980, then you can assume that the par value is the nearest whole number to one significant figure, which is 1000. Let us come up with the before tax cost here. The following numbers are plugged into the calculator. N is equal to 20 because we have a 10-year semi-annual coupon bond. The present value, which is the money that you raise or the money that the company raises by issuing this bond, is 980. Let's show that as a negative. Then the payments, these are the payments that are made to investors. The payment is based on the 8% coupon rate, but semi-annual. That means every 6-month coupon is 4%. 4% of 1000 is 40. And then future value is equal to 1000. That's the par value. When you enter this information, you then compute the interest rate. That will be the interest rate for a 6-month period. Here is what you should come up with. The interest rate for a 6-month period is 4.15%. We annualize that by multiplying by 2 and we have 8.3. This is the before tax cost of debt. After tax cost of debt is 8.13 into 1 minus the tax rate, which is 5.8%. Now I want you to do example 4 from the curriculum. Debt rating approach. Use the debt rating approach when a reliable current market price for a company's debt is not available. And here is how you do this. First, estimate the before tax cost of debt based on comparable bonds. So you look at the bond market, you find a bond which has the same rating as the bond issued by your company. Let's say that the bond issued by your company has a rating of A. You find other bonds with a rating. You also need to identify bonds which have the same maturity as your bond. Let's say the bond you've issued has a 5-year maturity. If the yield to maturity on this comparable bond is 10%, then that represents an estimate of your company's before tax cost of debt or before tax YTM. Then you consider your own tax rate. Let's say your tax rate is 30% and you come up with the after tax cost by doing 10% into 1 minus 0.3, which will be 7%. The cost of preferred stock is the cost that a company has committed to pay preferred stockholders as preferred dividend. In terms of a rate, the cost of preferred stock is equal to the preferred dividend divided by the current price. And it's important to recognize that we are dividing by the current price, not by the par value and not by the price at issue. A company issues preferred stock with par value 100. The dividend is 5 per share. The current share price is 125 and the tax rate is 33. What is the cost of preferred stock? What you need to do here is take the preferred dividend, which is 5, and divide by the current share price of 125, not by 100. So this is what gives you the cost of preferred stock. Also, since preferred dividends are not tax deductible, we do not consider the tax rate. I now want you to do examples 5 and 6 from the curriculum. Cost of common equity. Cost of equity is the rate of return required by a company's common shareholders. Estimation of cost of equity is challenging because of the uncertain nature of future cash flows. And this is an important point. You will see several models and formulas in this section. those models and formulas make it seem like the calculation is precise, but you need to recognize that these models are just approximations. The commonly used approaches or models are given over here: CAPM or capital asset pricing model, the dividend discount model, and finally bond yield plus risk premium method. We are now going to talk about these in a little bit of detail. Let's start with CAPM or capital asset pricing model. According to this model, the expected return on equity is equal to the risk-free rate plus the premium for the stock's market risk. Clearly, when an investor purchases a stock, he's taking some risk, and he will require a return, or he will expect a return that is greater than the risk-free rate. So we use the risk-free rate as a starting point, and then the additional return above the risk-free rate is based on the stock's market risk. The formula that you must memorize for CAPM is given right here. The expected return on equity is equal to risk-free rate plus beta, which represents the riskiness of the stock, multiplied by the expected return on the market, this is the overall market, minus the risk-free rate. This expression over here is also called the equity risk premium. Sometimes this is called the market risk premium. So let's do a simple example. In a developing market, the risk-free rate is 10% and the equity risk premium is 6%. Notice that this equity risk premium is the expression over here, which is given to you. The equity beta for this company is 2. What is the cost of equity using the CAPM approach? The cost of equity is equal to the risk-free rate, which in our example is 10%, plus the beta, which represents the riskiness of the company, 2, multiplied by the equity risk premium, which is 6%. The correct answer here is 12 plus 10, which is 22%. In some questions, you might be given the return on the market. So you might be told that the expected return on the market is equal to 16%. If this information is given, then you need to do this simple calculation: return on market 16% minus risk-free rate of 10%, which will give you an equity risk premium of 6%. For the risk-free rate, use the rate on long-term government bonds. Occasionally you will see the return on short-term government bonds, but theoretically using long-term bonds is more appropriate because equity investments are valued based on a long-term horizon, and it makes sense to use long-term bonds given that the horizon for equity is long-term. The equity risk premium can be calculated using historical returns. At level 2, you will learn several methods of coming up with equity risk premium, but the simplistic method that is referred to in this reading is the method based on historical returns. What you need to do is look at the returns of the overall market represented by a major index in that market. So in the US context, that would be, say, the returns on the S&P 500. You look at the index returns relative to the returns on the risk-free investment. The difference will allow you to come up with the equity risk premium. Now I want you to do examples 7 and 8 from the curriculum. Next, we will talk about the dividend discount model, but we need to understand a few basic items first. And some of this material is a refresher from quantitative methods. The present value of a perpetuity. If you have a given investment which gives you a perpetual cash flow at period 1 or the end of the first period, you have a cash flow of 10, end of the second period you have a cash flow of 10, and this goes on forever. We call this pattern a perpetuity. What is the present value at time 0 of this perpetuity? it is 10 divided by the interest rate. Let's say that the rate is equal to 5%. Then the present value is going to be 10 over 5% or 0.05, which is 200. You can also have a growing perpetuity, which says that you have your first cash flow of 10 at the end of period 1, and then this grows at a certain rate. Let's say that this cash flow grows at a rate of 2%. 10 at the end of year 1, which grows by 2%, and that will then become 10.2. This will then grow by 2% and so on. This 2% is a perpetual growth number. There is a formula for coming up with the present value if we have a cash flow that looks like this, and that formula is as follows. The present value at time 0 of a growing perpetuity is given by the cash flow or the payment at the end of period 1. Notice that it's the payment at the end of period 1 and not the payment at time 0, divided by the interest rate minus the growth rate. If our interest rate is 5% and growth rate is 2%, then the numbers that we would plug in would be 10 for the first payment divided by R, which is 0.05, that's the interest rate, minus the growth rate, which is 0.02. This expression will give you the present value of the growing perpetuity. Notice that the present value of the growing perpetuity has a smaller denominator compared to the regular perpetuity, and therefore this number will be higher, which makes sense because the numbers are growing. The other point is that if our growth rate is higher, instead of 2% it is 3%, that makes the denominator even smaller and the overall value becomes larger. This cash flow is important in finance because very often dividends or cash flows grow at a particular rate. When a company is stable, then the earnings or the dividends might grow at the GDP growth rate. Next point is that the value of a financial asset, such as a stock, is the present value of future cash flows. When we study equity later, we will talk about several methods for coming up with the value of a stock, but one theoretically appropriate method is to use the present value of future cash flows. When you hold a stock, those cash flows are the dividends. So you can come up with the value of a stock by estimating all the future dividends and then coming up with the present value of those dividends using the appropriate cost of equity. Gordon growth model is one example of a discounted cash flow. In other words, if we assume a dividend at the end of year 1 and we assume that this is growing at a particular rate, let's say G%, then we can come up with the present value using a formula like this. That model essentially says that the price or value of a stock is equal to D1, which is the first cash flow, divided by R, which is the cost of equity, minus the perpetual growth rate. This model is called the Gordon growth model. Here is the formula that I just gave you. The price or the value of a stock is equal to the first dividend. This is the dividend at the end of period 1 divided by R minus G. R is the cost of equity, G is the growth rate. But in this particular reading, we are concerned with the cost of equity. We can take the expression shown over here and use a little bit of algebra to come up with the cost of equity. The cost of equity is given by D1 over P0, the first dividend, divided by the current price of the stock plus the growth rate. D1 will be estimated, or in your exam question, you will either be given D1 or you will be given D0. If you are given D0, which is the dividend that was just paid at time 0, then you can calculate D1 by saying that D1 is equal to D naught into 1 plus G. But you need a G over here, plus you need the G for this part of the expression. So how do we come up with that perpetual growth rate? The answer is that you use this formula. The perpetual growth rate is equal to the retention rate into return on equity. So what is the retention rate? This represents the rate at which a company retains its earnings. If a company has a net income of 100, it can do two things with that income. Either it can retain or the company can pay the money out as dividends. If a company retains 60 and pays out 40, then the retention ratio is 60 over 100, which is 0.6, and the payout ratio is 1 minus the retention ratio, which is 0.4. Clearly, companies that retain a higher percentage of their net income will grow faster. That's why there is a positive relationship between the perpetual growth rate and the retention rate. The retention rate needs to be multiplied by the return on equity. Return on equity is net income divided by equity. Clearly, companies that have a high ROE are going to grow faster than companies that have a low return on equity. This is an approximate formula, but it's very important and you need to learn this. The growth rate or the perpetual growth rate is equal to the retention rate multiplied by the return on equity. If instead of the retention rate you are given the payout rate, which in this simple example is 0.4, then you can easily compute the retention rate by saying 1 minus 0.4, and then ROE is simply net income over equity. Cost of equity is the same as cost of retained earnings. This is an important concept. When a company raises new money, it needs to pay out dividends, and there we can think of the dividend as the cost of raising new money. The dividend payments are explicit, so it is easy to understand that the rate at which we are paying dividends or the amount of dividends paid will help us calculate the cost of equity. But what if a company is retaining its earnings? The company then doesn't make explicit payments, but is there a cost associated with retaining earnings? The answer is yes, and that cost is simply the cost of equity. We can think of the cost of retaining earnings as an opportunity cost, because this money really belongs to the shareholders. The money could have been paid to the shareholders who could have invested this money elsewhere on a similar risk project, and therefore in our calculations we take the cost of retained earnings as RE, which is what we calculate either using this method or the CAPM method. Bottom line is that cost of equity or cost of retained earnings are used interchangeably, and if your question on the exam talks about the cost of retained earnings, then the formulas and models that we have talked about apply. The Gordon growth model, which is essentially this formula over here, is also called the constant growth dividend discount model, because essentially we are assuming that the dividend is growing at a constant rate, and we come up with the present value by discounting all the future dividends. I want you to do this example now, and notice that you are being asked to use the DCF model. Here is what you need to do. The cost of equity based on the DCF approach is D1 over P naught plus G. This is an extremely important formula which you must know. We do not have D1. What we are given is the most recent dividend paid. This is D naught. To come up with D1, we do D naught into 1 plus the growth rate divided by P naught, which is the current share price, that's 30, plus the growth rate. But the question doesn't explicitly give us the growth rate. It needs to be calculated. The growth rate is the retention ratio into the return on equity. We are given the payout rate of 40%, which means that the retention rate is 0.6 multiplied by 0.15 gives us 0.09. We can now come back to the formula. D naught is 2, 1 plus G is 1.09 divided by the stock price plus 0.09, and here is what we get for the cost of equity. Bond yield plus risk premium approach. In this approach, we add a risk premium to the yield on the firm's long-term debt. The assumption here is straightforward. The return on equity should be greater than the return on the company's bond, because as we've discussed before, equity is more risky. If a company's long-term debt yields 8%, and we are told that the risk premium for the company's stock is 5%, we simply do 8% plus 5%, which is 13%.